They waited until the very last moment. They waited until the trading volumes were thin and the books were closing. Then, on the final trading day of the year, they pulled the rug. If you are looking at your screen right now, you are seeing a sea of red. You are seeing silver trading at $70, $50. We have crashed down from the highs of $75, giving back all the gains of the last 48 hours. For many investors, this feels like a betrayal. You held through the volatility, you believed in the breakout, and now, just hours before the new year, your portfolio is bleeding. But I am here to tell you that what you are witnessing is not a change in the trend. It is not a signal that silver is dead. It is a liquidity event. It is a dash for cash, driven by a specific bureaucratic rule that forces the biggest banks in the world to dump assets and hoard dollars on December 31st. In this emergency market analysis, we are going to dissect the New Year's Eve massacre. We are going to explain why gold and silver are crashing together. We are going to look at the Basel III regulations that mandate this sell-off. And we are going to explain why this crash is actually the perfect setup for the January effect that begins in less than 48 hours. The banks are cleaning their books. They are shaking the tree one last time. Do not let them take your fruit. This is the story of the final flush. To understand why silver is dropping today, you have to understand the mind of a banker on December 31st. Today is not a trading day for them. It is an accounting day. At midnight tonight, regulators take a snapshot of every major bank's balance sheet. This snapshot determines their capital requirements for the next year. It determines their systemic risk score, or GSIB score. If a bank is holding too many volatile assets like silver, gold, or stocks, their score goes up. If their score goes up, they have to pay billions of dollars in extra capital reserves. So, what is the logical move? Sell everything. Sell the gold, sell the silver, sell the bonds, and get to cash. Cash is the only asset that lowers the risk score. The massive red candles you see on the chart are not because Samsung stopped buying or because the shortage ended. They are because JP Morgan and Citibank need to show cash on hand to the Federal Reserve tonight. They are dumping their positions into a thin market to dress the window. This is purely mechanical, a regulatory flush. Because the market is thin due to the holiday, their selling has an outsized impact. They sell 1,000 contracts and the price drops 50 cents. They sell 10,000 and it drops $2. They are forcing the price down to raise liquidity. Once the clock strikes midnight, the rule no longer applies. The pressure lifts and capital can flow back in. This is why we often see a V-shaped recovery in the first week of January. The banks sell on December 31st and buy back on January 2nd. You are watching the sell leg of the trade right now. The buy leg is coming this Friday. It's coming. Let's look at the gold market. Gold is trading at $4,294, down $76. That is a massive move for gold. When gold sneezes, silver catches a cold. Because silver is a smaller, more volatile market, it amplifies the moves of gold. If gold is down nearly 2%, silver is down 8%. This correlation confirms that this is a macro event. It isn't just about silver supply, it is about the dollar. When banks sell assets for cash, the demand for the US dollar spikes. The dollar index is rallying today, not because the economy is strong, but because there is a shortage of dollars in the banking system to meet these year-end requirements. This dollar spike is a wrecking ball, smashing everything priced in dollars. But remember, a liquidity crisis is temporary. The Fed knows there is a dollar shortage. They will likely inject liquidity via the repo market tonight to stabilize the banks. When that fresh liquidity hits, the dollar will fall back down and precious metals will snap back up. We are in the eye of the liquidity storm. Now let's talk about the technical damage. A drop to $70.50 hurts the chart. It breaks the short-term uptrend and creates a big, ugly red candle on the daily chart. Technical traders who don't understand the fundamentals will see this and say, the trend is broken. Sell. This creates a wave of follow-on selling. Algorithms see the price drop and short more, pushing the price to the bottom of the range. We are currently testing the $70 support level. This is the line in the sand. We need this level to hold. If $70 holds, this entire crash was just a backtest of the breakout. It is a painful but valid technical move where old resistance becomes new support. If we bounce from here, it proves there is a floor of real buyers waiting to scoop up the discount. Looking at the volume, we are seeing absorption. Every time the price hits 70.50, buying volume spikes. Someone is stepping in front of the freight train saying, "I will take your silver at $70. That someone is the smart money preparing for 2026. Let's address the panic you are feeling. It is natural. You saw $75 yesterday, and you see $70 today. You feel like you lost money, but you have to change your perspective. Did you sell yesterday? No. Are you selling today? No. Then you haven't lost anything. You still have the ounces. The market is a mechanism for transferring wealth from the impatient to the patient. Today, the market is testing your patience. It is trying to shake you out before the January rally. It is trying to get you to hand over your position to the banks who need to buy back in on Friday. Do not give them the satisfaction. Think about the end game. Does a drop to $70 change the debt ceiling? Does it change the fact that China is paying premiums? Does it change the fact that mines are empty? No. The fundamentals are rock solid. The price action is just noise. Loud, painful noise, but noise nonetheless. We are going to go deeper into this analysis. We need to look at the physical disconnect while the spot price is crashing. Are dealers lowering their prices, or are they holding firm at $80? We need to look at the minor reaction and map out the strategy for the January 2nd open. When the banks are done selling, the vacuum reverses, and the price can go up just as fast as it came down. We are witnessing the final volatility of 2025. The storm is raging, but the ship is built for this. Hold tight. Let's pivot to the physical market reality. If you look at the screen, silver is $50. So you should be able to buy an American Silver Eagle for $74, right? Wrong. Go to the dealer sites right now. I'm looking at them as we speak. The premiums have expanded. Yesterday, the premium was $10. Today, it is $12 or $15. Dealers are refusing to lower their prices. Why? Because they know this crash is fake. They know it is a paper event. If a dealer sells you a coin for $74 today and the price snaps back to $78 on Friday, they lose money. They cannot replace the inventory, so they are keeping the price high. They are pricing in the real value, not the liquidity value. This disconnect is your signal. When spot drops but the street price stays high, it means physical supply is tight. It means there is no panic selling in the real world. Nobody is lining up at the coin shop to sell their stack. The only people selling are leverage traders on a computer screen. You must trust the physical market over the paper market. The physical market is the truth. The paper market is the manipulation. Consider the industrial view. Imagine you are Tesla or Samsung. You have a budget to buy silver for January. Yesterday it was $75. Today it is $50. Are you sad? No, you are thrilled. You are issuing buy orders as fast as you can, using this dip to lower your average cost for the year. This industrial buying provides a hard floor. The price can only drop so far before industrial users step in and buy everything. We believe that floor is right here at $70. Below $70, the value proposition is too good to ignore. Factories will clean out the vaults. While banks dump paper to fix their accounting, industry is taking the physical metal. This accelerates the shortage, moving metal from weak hands to strong hands. Once it goes into a factory, it never comes back. We also need to consider the short squeeze reload. The banks covered some shorts earlier this week, but to smash the price today, they likely had to reshort. They sold new contracts to drive the price down, which means they are back in the trap. They dug themselves out on Tuesday and jumped back in on Wednesday. Come Friday, when new capital enters, they will have to cover these new shorts. They are kicking the can, but they are kicking it uphill. Eventually, the can rolls back and crushes them. Short interest is building up again, guaranteeing future volatility to the upside. Every ounce they sell today is an ounce they have to buy back tomorrow at a higher price. Why does January 2nd matter so much? Because that is when the new money arrives. Pension funds, endowments, and 401k contributions. Billions of dollars flow into the market on the first trading day of the year. Right now, the market is illiquid with no buyers, which is why banks can push the price down so easily. But on Friday, the buyers and the volume return. When that wall of money hits this suppressed price, we will see a violent reversal. We could see silver jump from $70 back to $75 in one session. This is the slingshot. By pulling the price back today, they are loading the energy for the launch on Friday. Do not sell at the bottom of the slingshot. Now, I want to address the bear case. Could this be the top? Could silver go back to $50? Technically, anything is possible, but fundamentally, no. Not with the deficits we have, the war risks, or the debt. A crash to $50 would require a massive deflationary depression where factories stop working and people stop eating. If that happens, the government will print quadrillions of dollars, sending silver to infinity. So the bear case is actually a hyperinflation case. There is no scenario where silver loses value in real terms over the long run. How do you handle the next 24 hours? Survival. Do not look at your account balance. Do not calculate your loss from the peak. It is a paper loss. It is not real unless you sell. Focus on the ounces and the long term. Use this time to prepare for the new year. Audit your security and check your allocations. If you have cash, get ready. If we dip below $70 momentarily, that is the buying opportunity of the quarter. Be ready to strike. Be greedy when others are fearful, and right now, everyone is fearful. We need to zoom in on the technical damage. When a chart prints a massive red candle like we are seeing today, it breaks the short-term structure. Momentum traders who buy breakouts are gone. They got stopped out. Trend followers using moving averages are selling. This creates a self-fulfilling prophecy of short-term weakness. We have broken support at $72 and are now hanging onto the ledge at $70. Why is $70 critical? Because it was resistance for weeks. The ceiling we couldn't break. Now that we are above it, it must act as the floor. If we close today below $70, it opens the door to $68, the next major structural support. Is a drop to $68 fatal to the bull market? No. In the grand scheme, a correction from $83 to $68 is a normal Fibonacci retracement. It is a 38% retracement of the entire move from $50. Technically, it is healthy, but emotionally, it is devastating. It wipes out the gains of the last 2 weeks and makes you feel like you made a mistake, but you have to separate price from value. At $68, is silver less valuable than it was at $83? Has the utility or scarcity changed? No. The only thing that changed is the liquidity premium. The market is charging you less because it has less cash to bid with. That is a discount, not a devaluation. Let's dig into tax loss harvesting. This is the invisible hand pushing the market down today. Today is December 31st, the IRS deadline. If a hedge fund bought silver miners at the peak in 2021 and is still holding them at a loss, they sell today to book the loss and lower their tax bill on their Nvidia gains. They don't hate the miners, they just hate taxes. This creates artificial selling driven by the calendar, not the asset. Guess what happens on January 2nd? The tax year is over and the selling pressure vanishes instantly. The fund manager wakes up and says, "Okay, I booked the loss. Now I want the position back." So they buy. This is the wash sale dynamic. It depresses prices in December and explodes them in January. We are in the depression phase. The explosion phase is 48 hours away. Now let's talk about the miner capitulation. If you look at the GDX or SILJ ETFs today, it looks like a crime scene, down 10% or 12%. Investors are puking their mining stocks, saying if silver can drop $8 in a day, the miners are too risky. This is fear speaking. Look at the cash flow. Even at $70, these companies are cash flow monsters. But the market isn't pricing them on cash flow today. It is pricing them on liquidity. Miners are a high beta asset, the tail of the dog. When the dog gets whipped around, the tail snaps violently. But this snap creates the opportunity of a lifetime. We are seeing high-quality producers trading at valuations that imply silver is $30. The market has disconnected from reality. If you have cash, this is where you look. You buy the miners when there is blood in the streets. And today, there is a lot of blood. Let's pivot to the macro context. The bond market. The 10-year Treasury yield spiked today because banks are selling bonds to raise cash, just like they are selling silver. When yields go up, it tightens financial conditions, hurts the stock market, and creates a risk-off environment. But here's the catch. The U.S. government cannot afford higher yields. With $36 trillion debt, every 1% rise in rates costs the government hundreds of billions in interest. So, the higher rates go today, the more likely the Fed is to intervene tomorrow. The bond market crash guarantees the next round of money printing. They have to print to save the Treasury, and when they print, silver flies. This crash in bonds is actually the precursor to the next leg up in precious metals. It forces the Fed's hand. We are watching the system break, so the Fed can fix it with inflation. You own the inflation hedge. You are positioned for the fix, not the break. Let's look at the January 2nd setup. Markets are closed tomorrow for New Year's Day, giving everyone 24 hours to cool off and calculate. When they return on Friday, they will see silver at $70 and gold at $4,300 in a world still short of resources. Bargain hunters, pension funds, and industrial hedgers will be waiting at the open. The sell pressure from the GSIB rule and tax harvesting will be gone, creating a vacuum to the upside. Just as we fell into an air pocket today, we can rise into one on Friday. Liquidity will be low, but buying pressure will be new. Do not be surprised if we see a limit up open on Friday morning. The market hurts the most people possible. It hurt the longs today by crashing. It will hurt the shorts on Friday by ripping. The whipsaw is designed to clear the board. A word on physical delivery for January. First notice day has passed. Longs who stood for delivery are waiting for their warrants. You might think they would walk away with the price crashing, but they aren't. Open interest in the delivery month remains high. This means buyers want the metal. They are not scared. They are happy to take delivery at $70 instead of $79. This confirms the physical shortage. If buyers were speculators, they would have fled. The fact they are staying proves they are industrial users who need the atoms. The drain on the vaults continues. Today's price action is a paper storm. The physical foundation is unmoved. Let's talk about emotional capital. You have financial capital and emotional capital. Today, you spent a lot of emotional capital. It is exhausting to watch your net worth drop, but you have to recharge. Turn off the screen. Stop watching the red candles. Go celebrate the new year. You cannot change the price by staring at it. You have to trust your thesis. Why did you buy silver? Was it for a quick flip, or because the fiat system is mathematically doomed? If the fiat system is still doomed, the trade is still on. The timeline might have shifted and the path might be bumpier, but the destination is the same. Do not let a one-day liquidity event shake you out of a generational position. Consider the global perspective. While New York is selling, what is Shanghai doing? We don't have live data yet, but typically China buys the dip. When the West sells gold and silver, the East buys it. We are likely seeing a massive transfer of physical metal from Western vaults to Eastern vaults right now. The price drop facilitates this transfer, making it cheaper for China to drain the COMEX. We are subsidizing our own demise. History will look back at this as the day the West gave away its last strategic reserves for pennies on the dollar. In the next section, we will look at the recovery roadmap. How long until we reclaim $75? We will look at the V-shaped probability and give you the final checklist for the new year. The massacre is painful, but it is over. The recovery begins in 48 hours. We need to map out the recovery. The market has taken a punch to the gut, but like a fighter, it has resilience. What does the recovery look like? Based on the mechanics of this crash, the GSIB rule, tax selling, and thin liquidity, the recovery is likely to be V-shaped. The selling was event-driven, not value-driven. Sellers didn't sell because silver is worthless. They sold because the calendar said December 31st. Once it says January 2nd, the reason to sell disappears, creating a vacuum. Sellers leave, buyers return, and the price moves up to find liquidity. We could see silver reclaim $73 by Friday's close and be back at $75 by next Monday. The speed of the recovery will match the speed of the crash. With the price reset to $70, the upside potential for January is even bigger. If pension funds enter at $70, they can drive it to $85 without it looking like a bubble. This reset extends the runway of the bull market, giving us more room to run before hitting euphoria. In a strange way, this crash saved the rally by preventing a blow-off top that would have ended the cycle too early. Short sellers who made money today know the game. They know staying short into the new year is suicide, so they will likely become buyers on Friday to lock in profits. Short covering is the most reliable source of demand after a crash. Looking at macro data next week, PMI and jobs data, if it's weak, the market sniffs out a recession and a Fed pivot, which means lower rates and higher silver. If it's strong, the market sniffs out inflation, which also means higher silver. It's a win-win. The only thing that kills silver is stability, and the world does not look stable. If you're thinking about buying physical silver, this dip is your window, but you must be fast. Dealers see the same charts. If the price bounces Friday, they will raise premiums again. The discount window might only be open for 24 hours. If you have cash, now is the time. Even if the premium is high, $70 silver is cheaper than $80 silver. You are buying the dip in the base price. The gold to silver ratio has widened from under 60 to over 62, making silver cheaper relative to gold. This attracts ratio traders who will sell gold to buy silver, providing support and preventing a free fall. Regarding market sentiment, the anger and "it's rigged" comments are signs of capitulation. When retail investors give up, that is usually the bottom. The market has washed out the optimism and can now climb the wall of worry. Bull markets are born on pessimism, and today, pessimism has returned. Next week's Commitment of Traders report will likely show a massive reduction in commercial short positions. Banks use this crash to cover and de-risk. With banks less short, the path of least resistance is up. Expect a few days of consolidation between $70 and $72. This is necessary base building. Global liquidity is expanding as central banks ease. This money flows like water and will find its way back into silver in January. As we close the year, remember the big picture. You hold a strategic asset in a resource-depleted world. You own real money in a world of fake currency. The price dropped, but the value did not. $70 is just a number. The ounce in your hand is reality. This crash gave us a reset, a discount, and a launch pad. The massacre is over. The recovery is loading. 2026 is the year the warehouse hits zero and pricing becomes driven by scarcity, which is exponential. We could see silver touch $150. Do not let today cloud your vision of next year's reality. You survived the flush. You held the line. Now, enjoy your new year. You own the money of the people and the energy of the future. If this analysis has helped you navigate the year-end volatility and strengthened your resolve to hold real assets, please subscribe to the channel and like this video. We are dedicated to uncovering the financial truths that the big banks try to bury. Protect your wealth and prepare for the future. The next great wealth transfer is just beginning. Stay tuned for our next update.